Welcome to the Deep Dive. Today, we're going to be tackling something that might seem a little daunting at first,
Yeah.
the world of investing. You sent in a text called How to Invest for Beginners 2025.
Hmm.
Very futuristic. We'll unpack the essentials from this text and hopefully, by the end of this deep dive, make investing feel
Right.
accessible, maybe even a little bit exciting.
Yeah, it's pretty interesting how even the concept of like beginner investing is evolving
Right.
so rapidly. It really makes you wonder what investing is going to look like in a few years.
Right. So let's start with the foundation. Why should we even bother with investing? It can seem like it's just for,
Yeah.
Wall Street hotshots, but this text hints at a much broader appeal.
Oh, for sure. It's about, it's more than just chasing riches. Think about it. Like $1,000 today doesn't have the same buying power it did like a decade ago or even a few years ago. That's inflation at work, and investing helps you fight back against that
Yeah.
shrinking value and ideally have your money grow faster than inflation can erode it.
So it's not just about like getting rich, but about kind of maintaining your purchasing power over time.
Exactly. And the text really emphasizes the power of compounding, like making your money work for you. It's like that snowball analogy, right? As it rolls, it picks up more snow, becoming larger and larger.
Okay.
When you reinvest your earnings, those earnings generate more earnings, creating that snowball effect over time.
Okay. That snowball image really makes compounding like clink.
Yeah.
But like any good snowball fight, there's got to be some risk involved, right?
Yeah.
The market
Yeah.
isn't always predictable.
Yeah, for sure. And that's where the idea of risk tolerance comes into play. And, your text contrasts stocks with bonds, which is a good way to illustrate the spectrum.
Hmm.
Stocks can offer high growth,
Right.
but they also come with more volatility. Think of them as like the riskier, potentially more rewarding snowball. Bonds tend to be more stable, but with potentially lower returns, a safer snowball, maybe rolling at a gentler slope.
So it's about understanding those different levels of risk and figuring out what aligns with kind of like your comfort level.
Precisely. It's about matching your investments to your goals, your time frame, and how much risk you're willing to stomach. And it's not just a binary choice either. There's a whole range of asset classes beyond just stocks and bonds.
Yeah.
The text even mentions real estate, art, and like those digital assets, NFTs. The point is, there are diverse ways to potentially grow your money.
So it's like building your own personal snowball collection,
Mm.
each with its own
Yeah.
risk and reward profile. But
Mhm.
for someone just starting out, stocks seem like a good entry point.
Yeah, definitely. Stocks are a popular choice, and with online platforms making it easier than ever to invest,
Right.
they can be a great way to kind of dip your toes into the market.
Okay, let's break down stocks a bit more.
Sure.
What exactly are you buying when you buy a stock?
So it's essentially owning a tiny piece of a company. Imagine like your favorite tech giant,
Hmm.
like Apple, which the text uses as an example. Like, when you buy Apple stock, you're buying a small sliver of ownership in that company. So if Apple does well,
Yeah.
theoretically, the value of your stock goes up.
So it's like betting on a company's future, hoping they'll grow and innovate.
In essence, yeah. And there are two main ways to potentially make money from stocks. The first is through capital gains. So if the stock price increases, you sell it for a profit. The second is through dividends, where companies will share a portion of their profits with shareholders.
Dividends sound like a nice bonus.
Yeah.
But picking individual stocks seems pretty daunting. How do you even begin to know where to look?
Yeah, it can be overwhelming, especially for new investors. That's why your text mentions index funds and ETFs. Think of them as like pre-assembled baskets of stocks that track a specific market index, like the S&P 500. They provide instant diversification, meaning you're not putting all your eggs in one basket.
So instead of trying to pick like individual winners, you're spreading your bets across
Yeah.
a broader
Yeah.
segment of the market.
Exactly. Diversification is a core principle in investing.
Okay.
It helps to manage risk by spreading your investments across different assets.
All right. So far, so good. But there's a whole emotional side to investing that this text brings up.
Yeah.
It lists like common fears people have, like the fear of losing money.
Yeah.
It can feel like gambling, especially when you see headlines about market crashes.
Oh, for sure. And, it's understandable to be afraid of losing money. No one enjoys seeing their hard-earned savings dwindle. But the text makes a really important point. Historically, over the long term, the stock market tends to go up. That's why it's so important to have a long-term perspective and
Yeah.
not panic sell when the market dips.
So it's about riding out those waves
Yeah.
and not getting swept away by like
Yes.
short-term
Yeah,
fluctuations.
exactly. The text also addresses the fear of not having enough money to get started, which can be a major hurdle for a lot of people.
Right.
But nowadays, thanks to online platforms and things like fractional shares, you can start investing with really small amounts. It's more about establishing the habit of investing regularly,
Right.
even if it's just a little bit at a time.
So it's like building a financial fitness routine, starting small and gradually increasing your like investment reps as you become more comfortable.
That's a great analogy. And that actually connects nicely to another fear that the text mentions, the fear of starting too late.
Hmm.
It's true. The magic of compounding works best when you have time on your side,
Right.
but it's never too late to start. Even starting later, the power of consistent investing can make a real difference over time.
This is making me feel more and more optimistic. But the text also talks about this fast lane investing. What's that all about?
So this is where the text gets really interesting, I think. It's about thinking beyond traditional investments
Okay.
and recognizing that investing in yourself is actually a very powerful strategy. It's about boosting your earning potential so you have even more to invest in the future.
So it's like investing in your own human capital, your skills, and your ability to earn.
Precisely. The text lists examples like, learning in-demand digital skills, building a side hustle, and networking. These are all investments that can pay off in both personal and financial growth.
I love that concept. It's not just about waiting for your money to grow in the market, but actively taking steps to kind of increase your income and create more opportunities.
Exactly. And it ties back beautifully to the idea of compounding. You're essentially compounding your earning potential, which can have a significant impact on your overall financial well-being. It's a powerful combination, investing in yourself and then letting those increased earnings work for you in the market.
Right. I'm feeling very motivated by this fast lane concept.
Yeah.
But before we get too far ahead of ourselves,
Right.
let's distill some key takeaways from what we've covered so far.
Great idea. Let's break it down into some actionable steps. So first and foremost, start small and stay consistent. You don't need a fortune to begin investing. It's about building that habit of investing regularly, even if it's just a few dollars at a time.
So it's not about making like a grand entrance. It's about just showing up consistently and putting in the work.
Exactly. Second, remember the importance of diversification. Spread your investments across different asset classes like stocks and bonds to manage risk and potentially maximize returns.
Diversify those snowballs. What else?
Your emotions can be your biggest enemy when it comes to investing. Don't let fear or greed drive impulsive decisions. Stick to your plan, ride out the market fluctuations, and stay focused on your long-term goals.
Okay, so emotional discipline is key. Don't get caught up in the hype or panic when the market throws a tantrum.
Exactly. And finally, never stop learning. The world of investing is constantly changing, so read books, take courses, stay informed, and don't be afraid to ask questions. Knowledge is power, especially when it comes to managing your finances.
So be a lifelong learner, stay curious, and keep those investment muscles flexed. This has been an awesome start to our deep dive. We've covered a lot of ground, from the why of investing to the power of compounding and the importance of diversification. I'm already feeling more confident and informed.
There's definitely a lot to absorb, but you're asking all the right questions. We've really only just scratched the surface.
Indeed. When we return for part 2, we'll delve deeper into specific investment strategies and resources to help you get started on your journey. Stay tuned.
Sounds good.
Welcome back to the deep dive. We've explored the why of investing.
Right.
Now let's dig into the how. The text you shared, How to Invest for Beginners 2025, mentions this thing called a brokerage account.
Yeah.
What exactly is that?
So a brokerage account's essentially like a specialized bank account that's designed specifically for investing.
Okay.
Think of it as your gateway to the markets. And there are tons of options out there, from traditional brokerage firms to like those really sleek app-based platforms.
Okay, so how do you choose the right one? It feels like there are so many options, each with its own bells and whistles.
It's all about finding the right fit for your needs and preferences. The text emphasizes considering factors like fees, investment options, and the research tools that each platform offers. Some platforms are known for their super low fees, which can be great for beginners, while others might have a much wider selection of investment choices.
So it's a bit like choosing a gym.
I
Some are
see.
bare bones, while others have all the fancy equipment and classes.
Exactly. It's important to do your research, compare platforms, and maybe even like test drive a few with demo accounts before you commit. Find one that feels comfortable and aligns with your investing goals.
Okay, so let's say I've found my perfect brokerage match. What's the next step? I'm ready to start building my investment portfolio.
Well, before you jump into picking specific investments, the text really emphasizes the importance of understanding your risk tolerance. Are you okay with like a bumpier ride in pursuit of potentially higher returns? Or do you prefer a smoother, more predictable path, even if it means maybe slightly lower returns?
I guess I fall somewhere in between.
Right.
I want to see my money grow, but I don't want to be constantly checking the market with my heart racing.
Yeah, that's perfectly normal. Most investors fall somewhere along that spectrum. And remember, risk tolerance can also evolve over time as you gain experience and knowledge.
Okay, so uh, risk tolerance checked. What else should I be thinking about when choosing investments?
So your investment timeline is also really crucial. Are you saving for a short-term goal, like a down payment on a house in a few years? Or is this about those long-term goals, like retirement, decades down the road?
Retirement definitely feels like the long game. I know it's important to plan for the future, even if it seems far off right now.
Absolutely. And generally speaking, the longer your time horizon, the more risk you can potentially take on. Because, you have more time to recover from any short-term dips in the market.
So more time equals more room to play, at least within reason.
Exactly. It's about striking that balance between risk and reward, and that balance point will be different for everyone.
This all makes sense, but I have to admit, with all these different investments and strategies, it can feel pretty overwhelming. Are there any resources or tools out there that can help, simplify things?
Oh, absolutely. The text mentions that a lot of brokerage platforms actually offer really great educational resources, from articles and videos to like investment calculators and even personalized advice.
Hmm.
So don't be afraid to tap into those resources. Knowledge is your superpower when it comes to investing.
So don't just open the account and wander around aimlessly. Use the tools they provide.
Yeah, exactly. And remember our conversation about emotions, right? Fear and greed can really cloud your judgment when it comes to investing. So having a clear investment plan can really help you stay grounded and avoid making those impulsive decisions based on, short-term market swings.
Okay, so plan ahead and try to keep those emotions in check.
Yes.
Easier said than done sometimes, but I see how important that is.
It definitely takes practice. And don't beat yourself up if you find yourself getting swept up in the market frenzy now and then. It happens to the best of us. The key is to be aware of those emotional tendencies and develop strategies to manage them.
All right, so mindfulness and a solid plan. Got it.
Hmm.
But speaking of plans, remember that fast lane investing concept we talked about earlier?
Oh, yeah.
How does that fit into the bigger picture?
That's a great question. So remember, fast lane investing is all about investing in yourself, your skills, and your ability to earn. While it's not a traditional financial investment, it can have a huge impact on your overall financial well-being.
So it's like a parallel track. You're building your financial portfolio while simultaneously leveling up your earning potential.
Precisely. It's about recognizing that your earning power is an asset
Yeah.
and one that can potentially yield incredible returns.
This is so empowering. So how do you actually go about investing in yourself? It feels a bit more abstract than picking stocks or bonds.
Yeah, it is a little bit more abstract. It's about identifying areas where you can invest your time, energy, and resources to enhance your skills and increase your earning potential. The text mentions, learning in-demand digital skills, building a side hustle, or even starting your own business.
Right.
But it could also be something as simple as taking a course to enhance your current skill set, learning a new language, or attending industry events to expand your network.
So it's about being strategic with your time and effort,
Yes,
just as you are with your financial investments.
exactly. And just as you would research different investment options, you want to research different avenues for self-improvement. Identify areas where you have a genuine interest and where there's, potential for growth and opportunity.
All right, I'm feeling inspired to level up both financially and personally.
You're good.
But let's be real, finding the time and resources to invest in yourself can be tough, especially with a busy life.
Yeah.
Any tips for making it happen?
So start small, and gradually weave it into your routine. Maybe it's dedicating like 30 minutes each day to reading a book, listening to a podcast, or taking an online course.
So small, consistent steps, just like with financial investments.
Exactly. And remember, investing in yourself isn't always about like formal education or those expensive programs. It can be about seeking out mentors, attending free workshops, or even just having conversations with people who are doing what you aspire to do.
So be a sponge. Absorb knowledge and inspiration wherever you can find it.
Exactly. And don't underestimate the power of networking. Building strong relationships with people in your field can open doors to opportunities you might never have discovered otherwise.
Okay, networking, continuous learning. It's all starting to connect.
Yeah.
But before we move on, I wanted to address something that I think often gets swept under the rug when talking about investing: taxes.
Right.
It's not the most exciting topic, but I know it's important.
You're absolutely right. Taxes are often an afterthought, but understanding how your investments are taxed can actually significantly impact your overall returns.
So it's not just about how much money you make,
Right.
but how much you actually get to keep after the taxman takes his share.
Exactly. And different types of investments are taxed differently. For example, long-term capital gains, which are profits from selling assets held for more than a year,
Right.
are generally taxed at a lower rate than short-term capital gains. And some investments, like municipal bonds, might even be tax-free.
Okay, so it pays to be strategic about taxes when building your portfolio.
Absolutely. And don't be afraid to seek guidance from a tax professional if you're unsure about the specific tax implications of your investments.
All right, tax tips noted. But let's circle back to something we talked about earlier, the fear of losing money. What if someone has had, like, a negative experience with investing in the past?
Yeah.
How do you rebuild that trust and overcome those fears?
Well, past experiences, especially negative ones, can definitely have a lasting impact on how we view investing. It's important to acknowledge those feelings and not try to brush them aside.
So it's about recognizing that, like, financial anxieties are real
Yes.
and valid.
Exactly. If someone has experienced a financial setback, it's totally understandable that they might approach investing with caution. It's not about pushing them beyond their comfort zone,
Right.
but rather about creating a safe and supportive environment where they can explore investing at their own pace.
So it's about rebuilding that trust and confidence, like, step by step.
Precisely. It might involve starting with smaller, lower-risk investments and gradually increasing exposure as their comfort level grows. It's also crucial to have a, well-defined investment plan and stick to it, avoiding those impulsive decisions driven by fear or panic.
That makes a lot of sense.
Yeah.
It's about finding that sweet spot between, like, caution and action.
Exactly. And remember, investing is a journey, not a destination. There will be ups and downs along the way. The key is to stay informed, be patient, and focus on your long-term goals.
All right, feeling more grounded and ready to face those market ups and downs. But while we're on the topic of exploring different approaches, the text mentions something called alternative investments. What does that mean, and how do they fit into a beginner's portfolio?
So alternative investments are essentially anything beyond those traditional stocks, bonds, and cash. The text mentions real estate, cryptocurrencies, and even things like art and collectibles.
So it's like adding a little spice to your investment mix.
Exactly. But just like with any spice, you want to use it judiciously. These investments can offer diversification and potentially high returns, but they also come with their own unique risks and considerations.
Okay, I'm intrigued, but also a bit cautious.
Sure.
Where do we even begin with, like, exploring these alternative investments?
So just like with any investment, research is key. Understand the underlying asset, the potential risks and rewards, and how it fits into your overall investment goals.
Okay, research first. But what are some examples of these alternative investments and what makes them unique?
So let's take real estate, for example. It can be a great long-term investment, offering potential for appreciation and rental income, but it also requires significant capital, ongoing management, and can be illiquid, meaning it might not be easy to quickly convert it into cash.
So it's not as simple as, like, buying a stock online.
Exactly. It's a much more hands-on investment, requiring more time, effort, and expertise.
Got it. Real estate is more involved. What about those digital assets that everyone's talking about, cryptocurrencies and NFTs?
Yes. They've definitely captured a lot of attention in recent years.
All right.
But it's essential to approach them with caution. Cryptocurrencies, like Bitcoin and Ethereum, are digital currencies that operate independently of central banks. And they can be highly volatile, with prices swinging dramatically, making them very much a speculative investment.
So not exactly a smooth ride.
Not for the faint of heart. And then there are NFTs, which are essentially digital tokens representing ownership of a unique asset, often digital art or collectibles.
Right.
The NFT market is still relatively new and evolving, and the long-term value of NFTs is really uncertain.
NFTs, interesting, but proceed with caution. What about the more tangible alternative investments, like art and collectibles? Those seem a bit more approachable, like, something you can actually hold in your hand.
Yeah, investing in art or rare collectibles can be a way to combine your passion with potential financial gains. But these markets are often less liquid than traditional financial markets, meaning it might not be easy to quickly sell your assets. And valuations can be quite subjective depending on taste and trends.
So it's important to have a genuine interest and understanding of the specific market you're investing in?
Exactly. Whether it's antique furniture, vintage watches, or rare stamps, knowledge is key to making those informed decisions. And it's important to remember that alternative investments should typically be a smaller portion of your overall portfolio. The core of your investment strategy should still be built on those solid, diversified, traditional investments.
Okay, so dabble in those alternatives, but don't go all in.
Exactly. It's about balance and understanding how each piece fits into your overall financial puzzle.
This has been incredibly insightful. We've covered so much ground, from choosing the right brokerage account to understanding different investment options, managing risk, and even like dipping our toes into the world of alternative investment.
And we've only just scratched the surface.
Indeed. When we return for the final part of our deep dive, we'll explore some of the psychological aspects of investing,
Okay.
discuss the importance of continuous learning, and touch on topics like retirement and estate planning. Stay tuned for more. Welcome back to the deep dive. We've explored the nuts and bolts of investing, from stocks and bonds to brokerage accounts and diversification. But as we wrap up this deep dive, I want to explore a side of investing that I think often gets overlooked. The psychological aspect, this How to Invest for Beginners 2025 text, really emphasizes the importance of understanding our own minds when it comes to money.
Yeah, it's really fascinating how much psychology actually plays into our financial decisions. We like to think of ourselves as these like rational beings, but emotions can really sneak in there and influence our choices, especially when it comes to investing.
Right. So what are some of the psychological traps that we should be aware of? The text mentions something called cognitive biases. What are those?
So, cognitive biases are essentially mental shortcuts our brains take to try and simplify complex situations. They can be helpful in everyday life, but when it comes to investing, they can sometimes lead us to make, some pretty irrational decisions.
Okay, so like mental shortcuts gone wrong. What are some examples of these biases in action?
Well, one really common bias is confirmation bias, which is that tendency to favor information that confirms our existing beliefs, even if those beliefs are flawed. So let's say you've invested in a company and you're really excited about its prospects. You might find yourself, without even realizing it, more likely to read, like, those positive news articles about that company, while kind of glossing over any negative reports.
So it's like selectively filtering information to fit our narrative, even if it's not the full picture.
Exactly. Another tricky one is loss aversion. This is that human tendency to feel the pain of a loss much more strongly than the pleasure of an equivalent gain. Think about like holding on to a losing investment for way too long, hoping it'll bounce back, even when all signs point to selling. It's really tough to accept a loss, but sometimes cutting your losses is actually the most rational move.
It's almost like we're emotionally attached to those investments,
Yeah,
even when they're not really serving us anymore.
it's a very human response. And then there's the herd mentality, which is the tendency to follow the crowd, even when it goes against our better judgment. Think about all the frenzy around like certain hot stocks or investment trends. People get swept up in the hype, buying because everyone else is buying without necessarily doing their own due diligence.
So it's like the fear of missing out,
Yeah.
FOMO, driving
Yeah.
financial decisions.
Exactly. And those decisions can sometimes lead to some, pretty painful consequences. It's just crucial to remember that investing isn't about following the crowd. It's about making informed decisions based on your individual goals, risk tolerance, and your own research.
Okay, so awareness of these biases seems crucial, but how do we actually counteract them and make more rational decisions?
One of the simplest yet most powerful strategies is honestly just to slow down. Don't rush into any investment decisions. Take the time to really carefully research, consider all angles, especially if you're feeling emotional or pressured.
So take a deep breath, resist that urge to jump on the bandwagon
Yes.
and approach investing with a cool head.
Exactly. It's also super important to remember the importance of diversification. Don't put all your eggs in one basket, as they say. Spreading your investments across different asset classes can really help to mitigate risk and potentially even enhance returns.
Diversification check. What else?
And finally, never underestimate the value of seeking professional guidance. A financial advisor can bring an objective perspective, can help you develop a tailored investment plan, and also keep you accountable to your goals, especially when those pesky biases start creeping in.
So a financial advisor can act as a sort of, like, bias buster?
Precisely. They can help you navigate the complexities of investing and make those sound decisions based on your individual circumstances.
This is incredibly helpful. I'm definitely feeling more equipped to handle, like, the mental game of investing. But speaking of navigating complexity, this text also emphasizes the importance of lifelong learning when it comes to investing.
Oh, absolutely. The world of investing is constantly evolving. New technologies, investment strategies, and market trends are always emerging. To stay ahead of the curve, we need to embrace a mindset of continuous learning.
So it's not about, like, mastering a set of rules and then coasting.
Right.
It's about constantly adapting and expanding our knowledge.
Exactly. And there are so many great resources available to help us stay informed. Books, articles, podcasts, webinars. The options are honestly endless.
It's like having a whole universe of financial knowledge at our fingertips.
Exactly. And don't underestimate the power of mentorship either. Finding someone who has experience in the areas you're interested in can be incredibly valuable. They can provide guidance, support, and share those, hard-earned insights as you navigate your own investing journey.
Mentorship, check. Any other tips for embracing this lifelong learning journey?
Well, in today's digital world, online resources are truly a game changer. There are fantastic online courses, investment forums, and virtual communities where you can connect with other investors, learn from experts, and stay up to date on all the latest market trends.
So it's about harnessing the power of the internet for financial good.
Exactly. And remember, learning isn't just about passively absorbing information. It's about actively applying what you've learned, experimenting with new strategies, and even, making mistakes along the way. That's how we truly grow and develop as investors.
So it's about embracing the journey with all its twists and turns.
Precisely. And that actually brings us to another important topic that this text touches on: retirement planning.
Yeah, retirement might seem far off for some of us, but I know it's crucial to start planning early.
You're absolutely right. The sooner you start, the more time you have to benefit from that magic of compounding. One of the first steps is to really determine how much money you'll likely need in retirement. And this will depend on a number of factors like your desired lifestyle, projected healthcare costs, and even like your life expectancy.
So it's about envisioning your future self and the kind of life you want to live.
Exactly. And there are online calculators and tools that can help you estimate those retirement needs. Once you kind of have that target number, you can start developing a savings and investment plan to reach that goal.
Okay, so envision, estimate, and strategize. But with all the different retirement account options out there, like 401ks and IRAs,
Right.
it's hard to know which one's the right fit.
It's true, there are a lot of choices, but each account type has its own pros and cons depending on, your individual circumstances and your financial goals.
So it's another situation where, like, research is key.
Absolutely. For example, traditional 401ks and IRAs allow you to deduct contributions from your current taxable income, which can be a significant tax advantage, but you will pay taxes on those withdrawals in retirement.
So it's like a tax break now, tax payment later.
Exactly. With Roth 401ks and Roth IRAs, you contribute after-tax dollars, so you don't get that upfront tax deduction, but qualified withdrawals in retirement are tax-free.
So it's like paying taxes now to enjoy, like, tax-free income later.
Precisely. Which option is best for you will depend on your individual circumstances, like your current income, your tax bracket, and your retirement goals.
Okay, so it's a personalized decision, no one-size-fits-all answer.
Exactly. And if you're feeling overwhelmed, don't hesitate to, consult with a financial advisor. They can help you navigate all those choices and develop a retirement plan that aligns with your specific needs.
All right, professional guidance for the win. But while we're on the topic of retirement, I want to shift the focus from the purely financial aspect to something a bit more personal. This text talks about retirement as not just an end to work, but like a new beginning.
That's a beautiful way to frame it. Retirement planning isn't just about building a nest egg. It's about designing a fulfilling and meaningful next chapter in your life.
So it's about more than just like financial security. It's about figuring out how you want to spend your time, what brings you joy, and how you want to, contribute to the world.
Exactly. It's an opportunity to explore those new interests, travel, spend time with loved ones, volunteer, maybe even start a new venture. The possibilities are really endless. The key is to start thinking about these things now, not waiting until you're on the cusp of retirement. What are your passions? What brings you a sense of purpose? What legacy do you want to leave behind?
So it's about being proactive,
Yes.
envisioning the life you want to live,
Yeah.
and then taking steps to make that vision a reality.
Exactly. Retirement is a time to celebrate your accomplishments, enjoy the fruits of your labor, and create a life that truly aligns with your values and aspirations.
This has been so inspiring. I'm starting to see